The news on the housing market and economy was a mixed bag this week.
I have news.
And what sort of news do you have? Not bad news, is it? You know I can't take bad news. The day started out so good. Had a good night's sleep.
We got some good news when it comes to inflation, but we also got some troubling news when it comes to layoffs and the jobs picture. Let's jump into the details and get to the bottom line. Good morning. A variety of data points to go over with you today, but let's start with a few of the staples. The MBA released their mortgage application data for last week, and this shows purchase applications rising 4% last week. They are down, though, 46% year over year. Interest rates declined from 7.14% to 6.9% on average, so that's obviously welcome news. We love to see that. But last year at this time, rates were roughly 3.2% on average. So still in a very different environment. But we know the cause of that, a big thing, has been inflation climbing through the course of this year, driving interest rates higher. We've started to see some good news on inflation, so let's take a look at a couple of those information pieces. First one being the Producer Price Index. This is going to measure inflation on the wholesale or producer side of things. It's not as big of a market mover as CPI or Consumer Price Index, but it can still have an impact. And the October Producer Price Index report showed that overall inflation increased by 0.2%, which was about half of expectations. So that's significant. And year over year, inflation declined from 8.4% to 8%, much cooler than the 8.3% level that was expected. So seeing a cooler level of inflation there. And then you look at the core rate, which strips out food and energy prices. That was flat in October, softer than the 0.3% expectation. And as a result, on the core rate of inflation, the year over year decreased from 7.2% to 6.7%. So across the board, coming in lower than expectations, and another cooler inflation report, which we've now seen a few of. That cooler inflation is going to help the bond market and help interest rates. So we love to see that. A couple other data points to take a look at. We got some comments from Fed Vice Chair Brainerd. In some comments to Bloomberg News, she said that it may be a little bit too soon to slow the pace of rate hikes just yet, but that in the near future, we may be starting to see a slow of the pace of rate hikes. Makes sense for the Fed. So she added, the Fed's already done a lot, increasing rates from 0 to 4%, but they do still have some additional work to do. So what we look at this to mean is that it's likely setting up a 50 basis point rate hike in the month of December, but then at that point, it would be realistic to see the Fed pause, analyze inflation and the jobs picture, which we'll talk about in just a moment, to determine what they're going to do from here. One last point when it comes to inflation was the supply and demand imbalance in the trucking markets that we've seen over the past couple of years that have driven shipping costs and trucking expenses way up, has started to loosen significantly this year. The Cass Freight report, which measures the shipping costs across the United States, slowed to an 11% increase year over year. That's down substantially from a 21% level in September. So freight rates are starting to level off and soften in the months to come. And that's going to have a big impact because almost every good within our whole economy is going to be influenced by the cost of shipping. So this is definitely welcome news for the broader inflation picture. So now that we've touched on the good news a little bit, Jake, why don't you be the bearer of bad news? Tell us a little bit about what we're seeing when it comes to the jobs picture and layoffs.
Yeah, thanks, Kyle. So let's jump into unemployment. The unemployment rate remains low, coming in at 3.7% currently, but we know that the labor market is often a lagging indicator. So let's take a look at some of the layoffs that have been announced this year and will eventually be hitting these unemployment numbers. Coming up first, we have Twitter cutting 50% of its workforce, an estimated 3,700 jobs. Facebook cutting 13% of its staff, an estimated 1,100 jobs, and it's worth noting that this is the largest round of layoffs that Facebook has ever had. Robinhood is cutting 31% of its workforce, and Redfin cutting 13%. Now, other companies to make major layoffs are going to include Snap, Shopify, Netflix, Microsoft, Salesforce, Tesla, Lyft, Coinbase, and Stripe. along with hiring freezes coming in from Amazon, Apple, and Google.
Yeah, good stuff, Jake. It's important to keep an eye on those major layoffs occurring because you have to think at some point that's going to impact the unemployment picture. And the unemployment picture obviously is critical to our economy as a whole and also is going to influence the Fed activity, going to influence interest rates, going to influence the housing market. So good to be keeping a close eye on that, and we'll want to see if that trend continues when it comes to job loss and layoffs. Now, one other interesting piece of information to take a look at comes from Walmart. Walmart is a massive retailer, and they recently reported that 75% of their growth in the grocery side of things came from individuals that earn over $100,000 per year. So the reason this is interesting is because it shows a shift in consumer spending. It appears that even some of the higher earners are moving away from some of the more expensive stores, such as Whole Foods, and doing their grocery shopping at Walmart. So when you look at some of those trends, it gives us an indication on where the economy may be heading, because right now we're really at a point where things are shifting and changing. We want to keep a close eye on what may be happening next. We've seen a lot of changes already take place this year, but it's realistic to expect that there could be some major changes upcoming. So let's keep a close eye on that. We'll continue to cover the most important headlines, not just to the economy as a whole, but to the housing market, so that the industry professionals like us that are operating in this space on a daily basis, we have the information needed to inform our consumers and move in the right direction. So tune back in. We'll see you next week on the next episode of The Bottom Line.